It was a massive news week when it comes to the Australian economy. The Reserve Bank left the cash rate unchanged at 4.1% for the third consecutive month. The Reserve Bank has now paused in 4 of its last 6 meetings, which shows that we are at or near the cash rate peak. While there are only a small number of changes to the Reserve Bank's policy statement, the changes were telling. They show that the Reserve Bank now believes we are on that narrow path to achieving a soft landing. The statement explicitly highlights an easing in labour market conditions, describing the market as tight and no longer very tight. It also explicitly notes that the economy is slowing and inflation is coming down as expected. The RBA gave more importance to the downside risks associated with the underwhelming recovery in the Chinese economy, which has the potential to knock us off that narrow path. The other big piece of economic news was the release of the national accounts, which provide a comprehensive snapshot of the health of the economy. The accounts confirm the Australian economy is slowing. Economic activity expanded by 2.1% over the year to the June quarter, a step down from the 2.3% recorded in March. This growth was driven by an increase in services exports and public and private investment, which was largely driven by infrastructure. While the headline numbers were reasonable, looking underneath the hood suggests underlying weakness. The economy grew at 2.1%, while growth in the population was a very strong 2.4%. This means that GDP per capita went backwards. Indeed, this occurred for the second consecutive quarter, which means Australia has now officially entered a per capita recession. Household spending, which is the engine room of the economy, was only marginally positive over the quarter, and in per capita terms has fallen now for 3 consecutive quarters. Part of this was driven by a slowdown in average earnings, which actually fell by 0.4% over the quarter. This also saw more households draw down on their savings to support spending, with the household savings rate falling to 3.2%. Finally, we saw productivity growth fall again as the economy continues to normalise from the COVID pandemic. So, what does this all mean for the Reserve Bank? Incoming data suggests that the Reserve Bank is on the path to achieve a soft economic landing. We see the economy slowing further from here under the weight of high interest rates. As such, we think the next move in the cycle is more likely to be down in the second half of next year, when it becomes clear that the economy is in need of some policy support.